Assalamu alaikum, everybody. This is Imran from A Continuous Charity. Welcome to our live webinar and interview with two very great brothers, mashallah. We have on the show today Munim Salam and Amjad Qadri. Brother Munim is the Deputy Portfolio Manager of the Amana Income, Amana Growth, and Amana Developing World Funds, Adjunct Professor at IE Business School, co-author of A Muslim's Guide to Investing and Personal Finance. Brother Amjad is a Regional Manager at Saturna Capital Chicago, experienced in Islamic banking, including business and product development. Previous employers include Guidance Financial and University Bank in Ann Arbor. So let me welcome the brothers to the show. Assalamu alaikum, brothers. How are you?
Alaikum assalam. I'm hanging in there.
MashaAllah. How are you, Amjad?
Wa alaikum salam. Alhamdulillah, I'm well. You're going to hear me cough, but it started way before this recent COVID thing. So
it's funny. There's an allergy season going on here because we've had like really beautiful weather for the past 3 days. And so anybody who has allergies, it's actually like people are staying 10 feet away from that person, asking them to stay home and stuff like that. So a lot of confluence of different diseases going around that people are getting confused about. So
I hope everybody feels better soon to alleviate some of our stress. So brothers, I'm going to get straight into it. Could you quickly tell me about Saturna and Amana in terms of just very quickly why you guys exist, what you guys do, and what makes you guys unique and special?
Okay, I'll start off and I'm just going to fill in. Basically, the Amana mutual funds are the oldest and largest Sharia compliant funds in the U.S. We manage 4 funds, and really the story behind them is that the Muslim community back in the 1980s, because we have been around for over 30 years, Muslim community very small at the time, but they were looking for an alternative to putting money in the bank account for interest. And so they approached the local fund manager in Indianapolis, Indiana, and that's where kind of the agreement started. And so the Amana Income Fund was started in 1986, and the idea was just to provide an equity income for investors or for people who wanted to put money in the bank account. And then in 1994, we started a growth fund, which was much more aggressive. It was looking for more returns than the growth fund. And then in 2009, we started a developing world fund that was trying to take advantage of the emerging markets, the run up in them in the 2000s. And then in 2015, we kind of rounded out our product mix with a kind of like the halal income fund. And that's much more about capital preservation and really trying to conserve money. And so it's more a matter of, I think that the funds are really designed for Muslims. But really, it's become more of a mass appeal. So we have half of our investors are actually non-Muslim, either coming in purely for the return. They're coming in because we also have environmental, social, and governance standards in our funds. They come for ethical reasons, all of those different things. So we're very proud to be close to about $4 billion in size. Saturna has been managing the amount of funds since almost the very beginning, since 1989. Yeah.
And Amjad, go ahead.
The beauty about our funds, I've realized is that 34 years ago, if you can think back to 1986, the Muslim community was very small, but it's something that, really a few people that had a vision. And a lot of times I like to say this is, if there's a lot of people listening, any group of like 3-4 of them can do something similar, but really they did it the right way. They got the right criteria. And after getting the right criteria, they went and they found someone that was very well qualified to manage the funds. And that's where a lot of the success comes in. First, with the Islamic criteria, and second, with having the right person at the helm to make sure that happens and it's done in the right way.
So just quickly, you guys have mentioned ethical, and there also has been a lot of interest from like non-faith-based markets in terms of Islamic banking, Islamic finance. So just quickly, can you guys summarize why non-faith-based organizations are getting interested in our type of system?
So let's step back a little bit and let's try to define exactly what is Islamic investing, and then we can kind of segue that into why traditional institutions are getting involved. I think so. There's basically 3 sets of criteria that we look at. The first one is that when we first look at the entire market itself, our first screen comes from an industry screen, right? What is the company involved in? What are the major revenues coming from? And if those are coming from something that's not halal, then we screen those out. So we're screening out companies that are alcohol, tobacco, gambling, insurance, banking, pornography, pork products, those type of things. Once we've done that, Our second set of criteria is there to be able to limit the company's exposure to anything that would be either interest-based or anything harm-based. Okay, and what that would mean look like is that we have a debt to total market cap screen. Total debt of companies, how much they've borrowed in the long run. Market cap is basically the value of the company, right? That has to be less than 33%, okay, before we can buy it. And the second criteria is an accounts receivables, so that money that's about to be coming into the company over total assets, and that has to be less than 45%. And the last one is basically kind of a rounding out everything is like what we call the haram revenues to total revenues. There might be some ancillary business that they're involved with that might have some haram in it. They might have money in the bank account that's drawing interest, those type of things. And so as long as that's under 5%, then that would qualify as well. So that's the first two. And as you can notice, these first two are what are called negative screens, right? Where we're doing things that are not what the company does not do. The last screen is actually something we look at more on the positive side. So if you look at it from the positive side, we're looking at environmental standards the company has, how much water they're recycling, what type of energy they're using, carbon footprint, all of those things, rating it across the industry and looking for the best players. Then number two would be on the social side, looking at how their safety standards are, what their labor, do you have labor, what are the labor rights, those type of things. And the last one is the governance standards, which is more about diversity on the board, how do they compensate management, all of those different independence of the board, those type of things. And those are more the positive screens. When you combine all those together, we think we have a very good formula for being able to, in the long run, be able to outperform the market, right? And part of that is the reason why is because a lot of times what large institutions are looking for is they might sacrifice a little bit on the return as long as they can protect themselves on the downside with the risk. Okay, I mean, one time I was sitting with an institution in the Middle East, and it's like when he turned to me, he's like, "Look, Moneem, all I want you to do is not blow up my portfolio, right? You give me consistent returns, I'm okay with it. Just don't make me make that call that says I'm down 20%, 30%. That's what I'm looking for." And so, and I think that's why a lot of the non-Muslim institutions are coming in. A lot of the non-Muslim investors are coming in is because our ethics are strong. We have a very, very low minimum as well. It's $250 to get into the fund also. And so that's why they're coming in. They're coming in because of the returns. And that brings us to what happens when markets, for the past 12 years or so, the markets pretty much have gone in a straight line up, right? So people aren't used to the markets coming down as much as they have. And, our take is that when you have companies that have strong balance sheets that can collect on their bills and they're not doing anything that's haram, that's a recipe for success. And it's proving itself out in this environment that we're in right now.
So that takes us actually to our topic at hand, which is everything, the fear because of the corona, because of the COVID-19. So there's some studies and research showing that 20% of people are projected to lose their jobs. People are going to lose whatever they've put into various different stocks. So what are the different conversations you guys have been having with investors, with potential investors? How do we navigate the current climate? What is the current climate? Can you guys just kind of bring us up to speed with that?
Yeah, Amjad, why don't you start off and talk a little bit about what customers you're speaking to, and then I'll talk a little bit more about the economy and those type of things.
Well, I'll briefly talk a little bit about what customers are calling and asking about, and this has been almost all day. We're getting one of two questions. We're getting either the question of, the market is dropping. I've been in the market for a while, and, what should I do? Should I stay in the market or should I not? And the other one is, I've been wanting to get in the market for a while. Yes, Amjad, I've seen you at this convention, at that convention. Every convention I say I want to open an account and it doesn't happen. And, this seems to be the right time to do it. So I think those are the two main questions. One is either if I've been in the market, what should I do? And then if I haven't been in the market, is this a good time to get in? Are the two main things that I'm hearing almost repetitively.
Mm-hmm. And so, I mean, I think, taking that as a segue, look, you talked about 20% unemployment. I mean, we have to be very careful of the numbers. I mean, it's basically anybody's guess. But definitely, as it started off about 3-4 weeks ago to what it is now, it's become a lot worse, right? You're beginning to see the ramifications of implementation of social distancing, of companies not showing up to work, people not buying things, those type of things. So what you're initially going to have is probably, my opinion, this quarter might actually look pretty good because you had a lot of people stocking up on a lot of different things, right? So going to the grocery store, buying things so that they can, hunker down for 2-3 weeks, those type of things. So you are going to see an okay quarter for between January and March. The second quarter looks a little bit more dicey, and so it's more about how long this lasts, and that's where the unknown begins to come in. Because if this is a short recovery, which most people are saying it's not, then we might expect this to go into a little bit of summer, maybe into the third quarter. There are industries that are going to bounce back right away because there's pent up demand. There are industries that are going to take a long time to do it, right? So, for example, if you were going to, you're not traveling now because of your fear of the coronavirus and all the doctors telling you not to, rightfully so, you might not take a vacation as soon as this thing is over. So the travel industry is going to hurt a lot. However, whatever you bought and then you depleted your supplies of, whether it be toilet paper or Clorox, whatever it is, you are going to buy that back. So there are industries that are going to do well, or actually not do well, but pick up very quickly. Other industries are going to take a little bit longer to be able to do. Now, a lot of times, and we saw this in many other recessions or kind of financial crises as well, a lot of companies are quick to fire and slow to hire. Okay, and so that's what you're going to get right now. Is that, for example, Marriott came in and said they're going to, 10,000 people are getting laid off. GM, Ford's going to close down factories. All those things are happening. And from a business perspective, there's two reasons. One is your plants are sitting idle, nobody's traveling. Why would you want to pay your employees, right? You don't have that much cash. But the second thing is, the quicker you can lay them off, the quicker they can get on unemployment insurance, and then let the government take care of it. And that's what the government is beginning to do now. They're coming up with a package to be able to kind of give out handouts to people, businesses, and those type of things. So if you were in a situation of you might be losing your job, or you're coming into an environment where you're just graduating and looking for a job. I mean, I'll be honest with you, right? It's going to be tough finding a job as soon as you're graduating in June or July. But that being said, I don't think it's going to last quite a really long time, right? What do I mean by that? I'd give it probably about a couple of quarters and we'll be okay. And the market probably maybe another year or maybe 9 months to a year, and then it should be coming back from there.
Amjad, anything to add to the original question?
No, but I would just ask, you sound very confident, Munim. I think, if anyone's following the news today, there's a lot of people that have been on. I think one of the headlines that I saw, I haven't been able to watch everything or read everything, is, this is the beginning of hell or something. And I think it came from one of the really well-known investors that owns a lot of Hilton and some other industries. And he was mentioning something like he's talked to a lot of CEOs and he's told them all to prepare. And he said, he was advising the president, like, this is the time to really help out. So since you've been through this a few times now, since you've been in the industry for more than 20 years, is this the same things that you saw then? And if this is the same things that you saw, were the questions the same that people were asking? I think if people get an idea of why you feel is coming back in 9 months or a year, it'll make them feel more assured.
I mean, in 2008, I remember very distinctly that when, basically Hank Paulson was the Treasury Secretary at the time, walking in the Congress with a blank piece of paper and said, if you don't pass this bill and let me fill it in the rest, the world's going to come to an end. Like, literally, that's what he said, right? So people tend to forget that it's been a long time. So, I think we need to put that into perspective. Obviously, an owner of Hilton is going to say the world's coming to an end because he doesn't have customers or people staying at his hotels. So I think we have to kind of take that into perspective. And I'm not saying this is going to be over in 9 months, but I think what I was saying was it's going to start to recover by then. In the worst case scenario, right? If the second quarter turns out to be a negative quarter of -4%, that's as an example. That's next year's second quarter. It cannot be -4. It has to be more than that. So it has to be, so year-on-year numbers are going to begin to look a lot better. So no matter how much we come down, we are going to be able to pick back up. The question becomes is the uncertainty is of two things that are going on. Number one, how long is it going to last, and what is this thing called? What are we really looking at when we look at COVID-19? And we're overreacting in a good way, but it might be just an overreaction, and things might recover from there. That's possible as well. That's one thing. The second thing is that what is the government going to do about it? And that's, I think, we're seeing a little bit of unclarity, and that's why the markets are really reacting to that, because markets hate uncertainty. And so when the president about a week ago came out and said everything's okay, we're going to be fine, nothing's going to happen, the markets are like, oh my God, who do we have in power? And then 2 days later came out and said, okay, no, this is more serious than we have. A couple of days later, he's like, no, we have to shut everything down. But in the middle of that, he's trading that everything's going to be okay. So that's where you begin to kind of think about, is the government going to be able to help the economy or not? And that's where the uncertainty comes from. And you're seeing the sell-offs in the market and the huge gains and that type of thing. I do remember also, this is from a financial perspective in the markets, not very different from 2008. I mean, maybe the gyrations are more, like we've had more, percentage gains and losses in consecutive days for a very long time. But the idea is that in this type of in the crisis mode, every single good news will make the market go up a lot, and every single bad news will make the market go down a lot. And that's just it's natural for that to happen. And so for us as people who are investing, it's really more a matter of, ideally, if I had a crystal ball, I would have sold everything 3 weeks ago, right? I mean, that's, everybody knows that. But nobody did that, and if they did, it was purely luck. Nobody did it because they knew exactly what they were doing. So that being said, the idea becomes is that what do you do now? Are you going to be able to time it? Most likely, if you sell now, it's going to go straight up. If you keep it, it's probably going to go straight down. I mean, it's the law of, it's like Murphy's Law. So what you do is you come up with a strategy. As I got into this thing because I had a 10-year, 20-year, 30-year outlook. And because of that, I'm going to keep what I have in whatever I have. Yes, it's going down. If I have money on the sideline, I might want to add more. But really making a decision now, you're going to probably do it more from emotion rather than from a strategy. Okay, so that's where I think people need to kind of just from a market perspective, just kind of take a deep breath and slow down and say, what was my initial strategy, and what do I do from here?
So I think you defined really well right there for what to do for people who are already in. You mentioned something in there. You just kind of slipped it in where if you can put some more money in. Can you help people understand how to do that, or what you would suggest in a way of, if they're putting money in, do they put it all in now? Do they wait for the bottom to come through because they're trying to time it? How should they do that?
So, I think the idea is, again, nobody really knows where this bottom is going to be, but we have kind of a general sense of what's going to happen. So I think there's if you were somebody who was like, you know what, I'm going to try to catch the bottom, right? Bad idea. But what signs you're looking for that says now we can take a deep breath and say the market will become healthy in the future? Number one, we have a better idea of what the ramifications of this virus are, right? And we have either a cure that comes about, which is probably not for a while, but it doesn't have to be a cure. But we find out that the number of admissions in hospitals or those type of things are slowing down, and the number of cases and the number of deaths are beginning to come down. And we have examples of that. China was able to defeat it. South Korea was able to do it. Germany has a very, very low rate of mortality. So it is possible to do that. Okay, so that's one thing. The second thing is when you have the government stepping in and bailing out certain, either sending cash to people, bailing out some of the industries, those type of things. When those two things happen, then I think is the time when people are going to, the market's going to be able to breathe a sigh of relief. Okay, in the absence of that, right, I think the best strategy is not knowing, to be able to put it in tomorrow or Monday or Tuesday, whatever it is. Right, and again, come up with how much money do you have to be able to invest. Now, that being said, if you're one of those people that was going to fall into the unemployment rate of 20%, probably not a good idea to put it into the market right now. You want to hold the cash, right? And you want to wait because you want to know that your job is still secure. So we're not talking about that money. We're talking about money. A lot of people missed out on a lot of the gains that have happened in the market, and so those people are like, you know what? I still have a long-term horizon. I think I'll be fine. So what do you do in that situation? I think the best thing to do is, whatever money you have, divided by whatever you feel comfortable, divided by 4, divided by 8, however you feel comfortable. And every single week, just put a certain amount in. And, the first time you're going to put it in, market's going to go down more. You're going to kick yourself for doing that, but that's okay, because when the market goes down, you still have cash. You're going to put more money in, more in, and you're going to buy it at a lower price. And that's called dollar cost averaging. And the long-term strategy of dollar cost averaging is the fact that you will be able to lower your average cost. And so when the market does turn around and go higher, you will be able to benefit from it. I'm going to try to put one thing into perspective for people, if you don't mind. And that is that, the markets have been down a lot. It's almost, close to about, 25, 30%. In the S&P 500, we're only down to the levels we were in December of 2018. So we've only wiped out 1 year's worth of gains. And everybody was saying it was too expensive back in December and November. So if it was expensive then, and now it's less back to December 18 levels, now is an opportune time to get in, right? Even if we go down another, let's say 10, 20% from here, we'll only get to levels of 2015. So it's more a matter of, again, put things into perspective and say, if you have a retirement goal of like 30 years, are we basically gonna be better off as an economy, as a country, as the world 30 years from now, or are we all going to be, non-existent? So if we're non-existent, doesn't matter what you do with your money, we're not going to have it anymore. I mean, in that scenario. But if we're going to be better off, 30 years from now, then now is a great time to make an investment.
There's a question from one of the viewers, Umar Huck. He says, "Does China's decline in cases cause an impact in American markets?" And you were mentioning something about that.
It has a positive effect on the U.S. markets in general because, again, as China begins to ramp back up, the supply chain issue goes away, right? China is the manufacturer of the world, and so their factories were shut down initially. Nothing was coming out of there, and those type of things. But in order to be able to ship something out, there has to be a country to receive it, right? And right now, the U.S. is in lockdown, and so is Europe, and so. Yes, it's positive that China was able to get out of it and their factories are coming back online, but you still need to have the same thing happen in the US as well. Okay. The other thing is that China was able to implement something that most likely would be very, very difficult to be able to implement in the US. They basically put an entire city in lockdown, and they basically literally had an army surrounding the city and saying nobody's leaving the city, right? I went to the park the other day and half the park was full of little kids and parents playing, right? I mean, it's not our culture to do that. And so that's why in China, one city was isolated and basically was contained. In America, it's a lot different. It is spreading. It's probably going to spread more. The cases are going to go up. And the reason is because people aren't paying attention. They're not listening to the authorities, right? So it is going to take a little while. So does China affect it? Yes, it does. But really, in order for the U.S. markets to recover, we have to find the U.S. cases coming down and the death rate coming down as well.
Jed, any questions, or can I ask my next question, or any points?
I just want to make a point for everyone trying to time the market. I'm just going to be a little bit honest here. Monim and I talked 3 weeks ago. I'm sure Monim remembers, and I had some money for my kids' education sitting in our Sukuk fund. Our Sukuk fund is our low risk, low return fund. And I said, hey, this seems like a good time to move it into the market. The market had dropped. It was the first swing that it took. I think it went down about close to 8%. Monim, please correct me on the numbers. And so I asked him, I'm like, hey, is this a good time? He's just like, yeah, it could be. And I said, what I was thinking was just putting it over the next 6 days, thinking if this is close to the bottom, I want to try to, get it over the next 6 days. And we thought that was a good idea. What happens 2 weeks later? The market completely crashes another good 10, 12%. And yes, did I end up taking some loss by doing that? I did, but I don't feel bad because that 8% that went down, I definitely feel like when the market comes back up, it'll be higher than that. The ideal scenario is if I have more money to put it in now. That's not always the case because I moved it all over then, but I'm not afraid because, again, as Monim had mentioned in the beginning, if it's long term, then as long as you just you deal with the inclement weather, then the sun will come back out, inshallah.
Yeah, and the other thing is that in taking Amjad's scenario into perspective, Amjad never really lost the money because he never really sold out, right? Right now his value is down, and if values are down, the values will come back up. When you lose is when you decide to sell and not buying anything else, and that because now you've realized that whatever was down in the portfolio, you've realized that as a loss, and that's really, really important to keep in mind as well. I did see a question come across. Should I go ahead and answer that one?
Yes, please. I was going to ask that question.
About the asset allocation, right? Is that the one you saw as well? Yeah, that's the one, right? Okay. So, I think that So doing anything right now besides, look, if this was money you're going to save for Hajj for this year, right? Obviously, you're going to be in trouble. You might want to think about, liquidating and that type of thing. But again, long-term strategy wise, I do think it's okay to be able to keep whatever strategy you have right now, right? And don't do anything at all, because again, it's mostly going to be mostly based on emotion. If I asked the people a risk tolerance level back in December, they would have said, "Man, I'm so risky. It doesn't matter. It doesn't matter if I go down. I just really want to make a lot of money." If I ask the same person the question now, he's gonna be like, "Oh my God, I want to be as conservative as possible. I don't want to lose any money." It's an emotional thing. So what I would tell you is wait it out. Once we've actually gone to some type of a stability where the markets aren't going up 5% or down 5% in a day, then really look at your asset allocation and say, can you how much time do you have to invest in the market, and B, is it how much sleep are you going to lose if it stays this way for a long time, right? And then begin to reallocate your portfolio. But as of right now, I would say not a good idea. Just hang in there once you bottomed out, and then we can think about doing that. And that's for somebody who's 20 years old, 40 years old, even 60 years old, and they're going to be retiring in a year. Because one thing to keep in mind is that once you retire, it's not an end game. You don't go to all cash when you retire. You might still have, because of mortality rates in the US, you might live till you're 85. That leaves you 25 years before you retire. If you put it in cash, right? The one of the worst investments you could have made for the past 20 years in the market in anything was cash, because basically not only have you're eroding inflation, but cash literally has gone from paying 5% down to 0%. So you're not gaining anything by doing that, and there's no way your money will last if you do it for 25 years.
Can you explain what that means for people who've never invested? What do you mean when you say if you keep your money in cash as opposed to investing it somewhere, that it goes from 5% to 0%?
Sure. So if you look at, so I'm talking about, if you're very scared and you don't want to do anything at all, you leave your money in a savings account or in a money market account or something like that, right? Now, if you look at, I'll ask a question. Maybe you can answer it. Maybe you can, what the 30-year bond, which is the U.S. Treasury, in 1984, where it kind of reached its high. Do you know what the interest rate they were paying was?
No clue.
It's 15%. Okay, the 30-year bond now, or the 10-year actually hit below 1%, right? So it's basically a straight angle down over the past 30 years. So and if you look at money market rates or even savings accounts rates, it's the same thing. I remember back in 2004, 2005, if you put your money in savings account, you could have easily gotten about 4 or 5% rate of return, right? Now, if you put your money in money market account, you're barely going to get 0.5%. Right? So if inflation is running around 1.5, right, and you're only getting a 0.5% rate of return, then you're going to be losing out on 1% on cost of living adjustment, right? And if you're Muslim and you need to pay zakat on it, that's going to go down by another 2.5%, right? So there's no way that 2.5% times 30 years is a long time. So you want to be careful of that. So I guess what I'm saying is that from that perspective, one of the better places to put your money is in the stock market, right? Now, where your allocation is, how aggressive you are versus conservative, that does depend on your age, how long you have to invest, and what your risk tolerance is. But other than that, I think cash is minus maybe you need it for 6 months worth of living expenses. I don't think cash is a good idea as an investment tool.
What if someone rebutted and said, "Okay, I have cash and I'm saving money for the purpose of purchasing a house in a few years"? Is that a good reason to hold on to cash?
I think there are a lot of other like conservative investments that you would make, right? Again, let's supposing that like 2 years ago, right? Let's kind of take a historical perspective. Let's supposing 2 years ago, you decided you were going to be holding cash, right? And so you decide that you're going to buy a house in a couple of years. Should you put it in the market or not? And let's go back exactly 2 years. So March of 2018, right? Market was pretty much running up, and then it came a little bit down in October, November, December, and then it had a 30% growth rate. As you get closer to the point of when you're going to be needing the money, it obviously makes sense to keep more conservative, so you would have put more money in cash, right? If you would have left the money exactly the same, you would have lost the 2.5% and the 1% that I was talking about from there, right? Which is the zakat and then the cost of living adjustment. If you would have put the money in the market, right, you would have, maybe come out flat in 2018. Would have been up 33% if you left it all in the market. But because this would have been the year that you would have actually put that down payment down in the house, you probably would have become a little bit more conservative and saved some of that money in cash. You would be much more ahead than if you would have left the money in cash altogether for the whole period of time. Do you follow the argument?
Absolutely, yes.
Yeah. So that's what I mean by that. So I'm not saying, if you have 2 years, you could go all in aggressive and that would be too much. But really, even finding something conservative in the market, a good dividend yielding fund that will give you good growth and dividends coming in, profits from the companies. That's where you want to make your investments. I think over the long run, more than 2-3 years is a really good strategy.
The important thing there is over 2-3 years, because if you're saying, hey, I have some cash on the side, I met with a client just the other day. They said, hey, we have some cash on the side, but we're in a month-to-month lease and we're actively looking to buy a house. Then at that point, I think we would clearly say, absolutely leave it in cash, because if the market dropped like it did last week, the last thing we want is for you to take out less than you put in. But hey, I just got married, we got a good amount of money from wedding gifts, and plus I had some savings. We might buy a house in the next year or two. We're not even sure where we're going to move to. Then absolutely, letting the money do some work for you by putting it in all the places that Munim mentioned makes sense.
Yeah, and it's also not it's not a 0 or 1, right? It's a, you can take your money that you have and say, I'll keep 25% in cash and put the rest of it to work, or even 50% cash, put the rest. So it doesn't have to be all or none, right? And that's really important to be able to realize, is that, in the market, out of the market, you can do both. You can be both in the market and out of the market at the same time. And that might be giving you that diversification. So
we have another good question. I'm going to bring it up on the screen. What sectors should we focus to invest in right now? So going back to our few questions ago, in terms of, it seems like the right move is to invest if it's if you're financially able. But what are the sectors we should invest in?
That's an interesting question. So one thing that I would say is, in order for diversification, you need to, rather than trying to pick the sector or that type of thing, unless you really are going to be involved in it, you're better off just giving your money to a money manager and put it into mutual funds or something like that. So that's the first thing I would say. That being said, what are we looking at, right? So first of all, you want to look at and say, what is it that you've been buying and will continue to buy no matter what happens to the world? And a lot of times that's consumer staples, meaning that, you're going to keep buying toilet paper, you're going to keep buying Campbell's soup, and, you got to eat, right? So all of those things, and when everything looks like it's going to go to quote unquote hell in a handbasket, people are still going to eat while they're going to hell. So it's one of those things where you want to make sure that that those might be the industries that you're looking at. Healthcare, no matter how much strain is going to be put on the healthcare system because of this COVID-19, the healthcare system will come out of it, and it'll be coming out of it stronger, right? And so that might be another area you want to look at. So that includes pharma, includes hospitals, includes those type of things, right? But on a general level, what I would tell you is that you always want to buy companies that have solid balance sheets, right? By that I mean low debt and cash. And you always want to be able to be more more conservative when it comes to the companies that you're investing in, right? So for example, and I'm not making a prediction here, but let me give you an example. Let's supposing there was a car company, and very, very highly leveraged. It was a new car company. And they were only selling about 35 to 100,000 cars a year, all electric, right? And they ran, and the market came down, and now you're looking at they're highly indebted, for example. Are they going to be able to borrow money in 2-3 months from now when their last borrowing comes due? It's going to be a lot more difficult to do, right? So yeah, that stock might have run up because everybody thought everybody's going to buy an electric car, but you have to look at the balance sheet of the company and say, when times get tough, are they going to be able to survive? I don't have to use a car company. I can use even like an alternative energy, or I can use banks or sometimes similar oil companies. Sometimes you can find that are that the same way. Those type of things. Also, the other thing you want to keep in mind is in this market, right? There's the COVID-19 was one of the causes of the market going down. The other one you want to keep in mind is that there was the situation with oil, right? Now, naturally speaking, if everybody's staying home and they're working from home, right, and they're not producing anything, oil demand will go down, right? So when oil demand goes down, prices are going to drop. What compounded it was that when Saudi Arabia saw this coming, they went to OPEC plus Russia, and they told Russia, why don't we cut production so that we can maintain the price of oil? And basically Russia's answer was, no, thank you. And so then Saudi Arabia responded by saying, okay, you want to play that game? We're just going to increase production and drive the oil prices down. So that's why last week on Monday or Tuesday, oil prices went down by 20% in one day, right? And so that has disruptions in the economy in the U.S. as well, because U.S. has become, up until even now, U.S. is a net exporter of oil if they could do it. There's laws against it, but they produce enough oil to be able to maintain themselves. So the shale producers that are there in Texas and other places, they're hurting because it's a very expensive way to be able to produce oil. They cannot make money at $25 a barrel of oil. And so, do you really want to be in those industries? Probably not, right? But you do want to be in the industries that are going to continue to do well. Think about technology, right? We're having this kind of the broadcast. We're doing it live. We're doing it online, right? How many other companies are shifting their strategy online? So what companies benefit by more and more meetings occurring online, right? Look at the pipeline companies, pipeline for internet, Cisco, and all those things, right? So kind of think about it and say, in more like the Peter Lynch model, right? Which was a great money manager back in the 90s. He said, I only buy things that I use. So are you going to stop using your iPhone because the reception is down? Probably not. But even if you do, and you keep your old one for a little bit longer, a lot of the revenues for Apple are coming from subscription services, and they're not coming from the iPhone itself. So those are the things you want to look at.
So you mentioned disruption in a sense, right, for certain companies. So one of the questions that came in was, what sectors? No, could this be the end of paper money? Should we invest in gold and silver?
So we get this in any scenario where there's a recession. People said the same thing about fiat money in 2008. They also said it in 2000 when you had the what do you call it? What was the turn of the century? The 00 thing called? I can't remember now. But anyway,
Y2K.
Y2K. That's what it was. Y2K. So people talked about that as well. So you're always going to be having people that are going to say that, right? But really, gold is not an investment, right? Gold is a storage of cash. Okay. So what I mean by that is when you buy gold, it doesn't produce for you, right? It doesn't give you any benefit. There's no dividends. It's not a company that's going to go out there and make money and give you money back. It's basically a storage of your value, right? Now that was traditional case that you could easily replace gold with money and you would be fine. But over the past 15 or 20 years, because central banks have been buying more gold, because there are ETFs now that are in gold and they're basically buying and selling really quickly, that idea of gold holding value is no longer the case. You can easily be up or down 20% in gold in 1 year, right? So it's not the same thing as cash. So what I would tell you is, as a replacement for cash, not a good idea. As an investment, it's possible. So you should have, maybe some diversification in gold if you really needed to. On a general basis, I would tell you that gold is a better investment on the hand of your spouse than it is sitting in bullion or as a holding cash. You're going to get a much better return if you buy your wife a gold ring or a gold necklace than you would sitting there in gold bullion.
So you guys mentioned a few sectors that we could potentially invest in, and off the bat, I think of communication technology, medicine, even disruption is going to be going on in education. So different things that could promote education in terms of distance learning and whatnot. So if someone wanted to invest in these companies, do you recommend a first-time investor to download Robinhood or some app like that, or should we contact people like yourselves?
I'd like to take this one.
So, I was thinking about that when the sector question was initially asked. And I'll just be, again, honest with you guys. I mean, I told you guys about my move 3 weeks ago. And the whole point I did that for is I want to be as transparent as I can in trying to help everyone. That's our goal. And I'll be transparent here. I haven't bought individual companies, and I'm in the industry. I'm not trying to buy individual sectors. To me, that's also trying to time the market. For majority of us, I mean, I have, a few kids that occupy a lot of my time when I'm not working. And on top of that, if I'm trying to see, hey, is this sector correct? Will I get this right? Am I going to sell at the right time? It's just something that, you know, I feel at this point in time in my life, I don't have the extra capacity to handle. So for me personally, it's just easier to buy mutual funds. I mean, A, ethical and Sharia compliant ones, because that's what I want. And then B, mutual funds that have a historic record of both doing well in the downturns, but doing well overall. So to me, you know, our funds have done that. And so if I, like with the money I had, you know, as I mentioned 3 weeks ago, I just moved it over into our growth and income fund, favoring growth a little bit more. So if I had more money, I would probably just split it between the two and put it in, because that keeps me from having to worry about individual sectors. You know, who knows what's coming up? Even if the market starts recovering, as Monim said, you know, the one sector that I decided to go in, and you know, it's Murphy's Law. Everyone thinks what they go into goes down. I would feel whatever I decided to go in, you know, I would feel that it would go down. So for me, it's just easier to say, you know, someone way smarter than me that's been doing this for a long time, that has a great track record, pick these 60 companies. They already did all of the research when it comes to both ethical, sustainable, and Sharia compliance. I'm just going to group it and put it in there. Yeah, my upside might not be as much. Like if I just bought the one company that really quadrupled or tripled, you know, the one mask company that is coming out with masks right now. But I'm okay. You know, what I've learned, and now being older, is I'm okay with slow, steady growth, because trying to, you know, get that one off, usually you end up losing more. And even the people that say, hey, you know, I got the timing right, majority of the time they'll tell you about their successes. They will never tell you about their losses. And a lot of times the losses end up being more than the successes. From, again, what I've seen, again, I'm letting Monim do most of the talking because he is the one with the 25 years experience. So everything he said about the last downturn, really, it opened my eyes, because, you know, I'm asking, is this the first time we're hearing this? And he told us, you know, Fed went to Congress and basically said, hey, it's ending, the same things that we're hearing today. And that gives me more surety that, okay, this looks similar and it's probably something that has happened before. Sorry, Monim.
No, I was just going to talk a little bit more about the diversification issue, right? And that's something that I think maybe a lot of the people on the broadcast might be able to think about, and that is that you know, a lot of times you want to invest in the industry that you know. So, for example, you know, if you're in technology, you want to buy only technology companies because that's what you know. You work for a company and you want, you know, they're giving you employee stock purchase plan. You put it all of it in your 401k, and that's what you're buying. The problem is during this environment, right? Which is at the same time that the market is coming into, or the economy is going into recession, right? You're going to be holding your own company stock, right? And you're probably, you know, as the company stock's coming more and more down, you're probably more at risk of losing your job, right? So that's why diversification comes in really, really important, right? Is that if you're working in an industry, you know, if you had a portfolio that was much more diversified in all the different sectors, rather than only the sector that you know best, and you thought that, you know, this was going to be a quadrupler or a tripler, right? It's better to be diversified just because of these type of issues. And, you know, majority of the people are not built to be able to quote unquote gamble with their life savings. And even though you think you might be, when the markets are going up. So really, it's always kind of take a step back, you know, take a deep breath and say, you know, do I really want to be all in the company that I don't even own? You know, I'm just working there, kind of a thing. So,
let me ask a random question, because I'm a complete novice at this. When the federal government cut the rate, whatever the rate is, to zero or near zero, what does that mean, and what benefit does that have on potential investors or loaners, I guess?
Okay, so this is basically purely having to do with financial institutions, and not as much to do with individual investors, right? The Fed, for the most part, does not control what happens to you and I, right? But that's a second. We are a secondary benefit. When the Fed was looking at this thing and saying what's really going on, right? What they were finding out is that, wait a minute, if we don't if interest rates are 1%, for example, right, and, you know, banks are beginning to stop lending, right, then we're going to cause a choke in the economy, because businesses are going to need to borrow, but they can't borrow because banks aren't lending, right? So what they basically did was, what banks have a facility to do is they have a facility to be able to park money overnight in the Federal Reserve. Okay, Now that rate of return right now, before this crisis started, was roughly around 1.25 to 1.5%. When the Fed cut it, they basically said, we're taking the rate and now we're only going to pay you 0.25%, right? When they did that, the math of how the bank makes money completely changes, right? So ideally, what they would be doing is they would be then going there and spending more money on the economy, letting people borrow more money. And if they ever needed to borrow money from the Fed to do that, they would be doing it at a lower rate. So that's where our kind of thing comes into play. Now, a lot of thing is that if you look at mortgage rates, that's the most immediate benefit you'll be able to figure out whether it's working or not. Mortgage rates have actually gone up, even though the Fed has been lowering. And you might ask yourself the question, that's kind of counterintuitive. And when I first thought about it, I was like, yeah, it is kind of counterintuitive. Mortgage rates should have come down. The problem is that there was so much demand for mortgages after the Fed cut rates, right? The banks needed money to be able to give to corporations, right? Because that's a lot more of a moneymaker than to mortgages. And so in order to slow down the demand, they kept the interest rates on mortgages artificially high, or actually even raised them. Okay, so that's why you haven't seen that, and that's something it is counterintuitive. It doesn't normally happen, but it's happening in this environment because of the reason that the banks can't just take in that much money. The mortgages will always make them less money than a corporate loan will, and so that's why they're much more willing to lend to a corporate rather than to an individual. So that's where what's called the Federal Open Market Committee. That's what they do, is they set the interest rate of borrowing for banks that are around the country.
Yeah, thank you. I had no idea what that meant, and you explained it very well.
Thanks.
So we have one more question. I'll put it on the screen. Also, you mentioned that recovery will be probable once we know the ramifications and government stepping in. By government stepping in, do you mean all stimulus or a particular tool the Fed is using, etc.?
So that's thank you for that question. So again, as I mentioned to you, the Federal Reserve only looks at the market operations of the economy, right? So it has to be both what's called when the Federal Reserve does it, it's called a monetary stimulus. Okay, and then what the government does is called the fiscal stimulus. Fiscal stimulus affects us directly as consumers, right? So when I was talking about when the government steps in, I was more talking about the fiscal stimulus more than I was the monetary stimulus. What I mean by fiscal stimulus, it could be anything. It could be that back in after 2008, you had the cash for clunkers program. You had payrolls suspension for payroll taxes. You had money, the government literally was sending checks to people like they're thinking about doing now. Those are all considered fiscal stimulus, right? And that's when the government comes up with a good policy for that, we are going to see some type of a calming down of the markets.
Thank you. So essentially what I'm going to do now is give you guys, well, I'll ask one more question and I'm going to give you both closing remarks. And then if we have any more questions, we can take a few. But if someone wants to reach out to you during this time, are you guys still readily available, meaning the representatives of your organization? Is it still very feasible and practical to reach out to you guys for investment sake?
So it is. Our call volume, as mentioned early on in the call, has gone up drastically. And each call is lasting longer as people are worried about what's going to happen with their money. So be patient with us as much as you can. If you know one of us directly, reach out. I'm happy with people reaching out to me. I can leave an email address, as I'm not sure where you could put that, but you can put that with the video. And I'm happy for people to reach out and just let's set up a time and try to talk. We are trying to get through every conversation as we can. As I mentioned, anyone that ever thought about it is really like trying to get everything open right away. And I would also say, if you want to try to do this soon, you really need to move, because I'm not kidding about almost a lot of people that I've met over the years that every time I see them, they're like, I really need to do this. Even within my 401k, they've all reached out. So really it's a matter of being able to get through helping everyone. We want to do it. We want to do it quickly because we want to be able to help everyone, take advantage of the opportunities in the market.
And closing remarks from both of you. What's your closing advice, closing summary? People are scared. Maybe some people are tuning in late. So what advice do you have for us as we close the program?
I'll go because Monim, I want you to finish it. The only thing I will say is really it's less about investing, because investing during this time I feel is a little bit secondary. But for us to get through what's happening here, we mentioned that we're seeing China come around. The only reason that was able to be done is because the government really clamped down. Our government is not making it mandated, but for us to get through this as citizens, if we don't really do what's being recommended and treat it like what's actually you have to do, that's how we're actually going to see the graph flatten. So let's keep that in mind. Let me just take this questions on 401k investing, how to do it in the Islamic perspective. That's a very, very important question. I brought that up, when I was just talking about 401ks. If you work at a company and you have a 401k, we have many, many companies that allow you to invest in the Amana funds. It won't be one of the 10 or 15 funds that you see right away as a choice, but what you have to do is you have to go through the brokerage option. So, I have a few friends that work at Amita Hospital, and I have a few friends that work at Cisco. They both have the option to go through the brokerage part of their of their 401k and then buy the Islamic funds through there, and you still will get your match and everything else. So you won't hurt yourself by doing this. It just gives you the ability to have completely Islamic funds, but to be able to do it through your company. And with mentioning 401k, this is a good time to increase your 401k deposits. If you're not maxing it out, or if let's say you put in 10% for the year, really try to put in that 10% now over the next 2-3 months. We have 3 months that have went by, so ideally you would have already put in 2.5%. Put the next 7.5% in the next 3 months if you can afford to do so. Again, to try to take advantage of the market. And then you'll end up not putting any towards the end of the year, but that's okay. And if you can afford it, especially if you're at 10% and you can still afford it, put 2-3%, the rest of the year, and just take advantage of that.
Thanks for Amjad. That was really good advice. I think my take on this is, I know people are down in their portfolios. I think people are getting worried, but one thing to keep in mind is if you take the longer term perspective, then this too shall pass. Okay. I think if you're in your 20s, 30s, 40s, you get these cycles where you have these tremendous buying opportunities, and this is one of those opportunities, right? And so really, if you have the cash on the sidelines, if you thought you were waiting for the right time to do it, now is that time, right? I don't know if it's today or tomorrow, but now is that period of time that you want to be able to do that. Diversify your portfolio. Make sure you're not putting into that one stock you think is going to do well, but have a good diversified portfolio of what you want to be able to invest in, and then also just be extra vigilant. I mean, at the end of the day, we are, as Amjad mentioned, about controlling ourselves as to what we do. Of course, there's a power of prayer as well to be able to kind of calm ourselves down and being able to do that. But really, I can't think of a scenario unless you were really in your 80s and all in the stock market, where really time would not be on your side. I think it's more a matter of let this thing wait. If you do want to change your portfolio, those type of things, let this thing play out, and then you'll have time to be able to readjust it and still be able to benefit from whatever downdraft that happened in the market, right? But again, I said the same thing back in 2008, when literally people thought the world was coming to an end. In the financial markets at least, and it was like this will pass, and it will pass. And 10 years from now, would you rather be the one who is patting themselves on the back because you did have the guts to be able to put money in, or would you be the one kicking yourself in the butt because you decided you weren't going to do it?
Thank you both so much. I'm going to just plug the website real quick. It's www.amanafunds.com, amanafunds.com, and the email address is amq@saturna.com, saturna.com. Thank you both for joining the show. It was very beneficial and very benefiting. I mean, I honestly learned a lot of terms and a lot of things that I didn't know. So I'm hoping that our viewers were also able to benefit from it. And thank you for sharing your resources, your website. I hope people do reach out. And if people have any more questions, I'm assuming they can reach you directly at your email, Amjad?
Yes.
Awesome, awesome. And for our viewers, this is ACCA Continuous Charity. We're providing interest-free loans so students can pursue their higher education goals and dreams. Please visit our website, acceducate.org. We have a variety of webinars and programs we're going to be doing over the next few weeks. We have our very own and good friend Habib Qadri, National Distinguished Principal Award recipient, who's going to be on the show sometime next week. We have our friend Abdullah Duro, who's going to be showing us how to do home exercises, how to stay fit while we're under quarantine. And we're going to have many, many more join the show. So thank you guys again for joining. Visit us at acceducate.org and see you guys soon.
Thank you.
Thank you, Imran.